an economy that, at least in the U.S., while still strong in a headline sense, is not working for all people, and one where you have an ongoing challenge with artificially low interest rates and stubbornly higher inflation. So I think we have an interesting set of circumstances to navigate. I'm not, as you know, a doom and gloom guy. I believe that the world will be a substantially better place ex-war 20 years from now than it is today. But I think we have some challenges to get through in the next 2 or 3 years, and I think investors need to keep those challenges in mind.
You're watching Silver News Daily. Subscribe for more.
Rick Rule, a name synonymous with market insights, just dropped an astonishing prediction. Silver could be on the brink of hitting all-time highs. Think it sounds far-fetched? Well, let's dive in because Rick believes there are powerful forces at play that could send silver prices through the roof. In this video, we're unpacking all the key drivers behind his bold forecast, some of which might surprise you. So if you're considering where to put your money, you won't want to miss this breakdown. Let's jump in.
I think one reason is artificially low interest rates. If you had free market interest rates, if the Fed didn't set the interest rate in the U.S., but rather the market set the interest rate, my suspicion is that the interest rate would be 2.5% or 3% above the real rate of inflation, not the CPI stated rate of inflation. Artificially low interest rates penalize savers, middle-class savers, and they benefit investors. They benefit people that have access to credit and access to the knowledge as to how to employ it. In other words, they benefit me, but they penalize middle-income savers and people in the last 40 or 45 years who have had access to credit and the education necessarily to employ credit, at least in the period 1982 to 2022, have done very well, myself included. Those people who haven't had access to credit or haven't had the knowledge base necessary to employ it have had challenges. And those people who relied on traditional methods to get ahead, including savings, have been penalized by deposit interest rates that were lower than would otherwise have been the course. So yes, I think that artificially low interest rates have been an important part in the demarcation, the economic demarcation between the 1% conservatively, probably more like 5%, and the 95%. I think another point has been the fact that we lost sight during a period of economic boom that you had to develop specific skill sets to get ahead. You make money by delivering value to people. The service that you sell or the good that you sell has to deliver enough value to the consumer that he or she willingly parts with money. The idea that many people in the economy have is that you trade time for payment. There are a lot of people who don't have the disconnect between the utility that you create in your job and the way that you get compensated. The economy was strong enough and benign enough for a period of time that people could just show up and collect their checks. That period of time is no longer true. It was particularly true, of course, in the West. But in terms of globalization, what we've learned is that there are a bunch of people in other parts of the world who are willing to do things that we used to consider to be our sole province, and they're willing to do them better, and they're willing to do them for less money. The idea that an auto worker in Western Europe or the United States who is 55 or 60 years old can employ capital better at $70 an hour than a 24-year-old can employing that same capital in India or China is fallacious. And I think that the rank and file of the citizenry needs to reestablish the connection in their own mind between the value that they contribute at work and the way that they're compensated. And I don't think that that's true. And I think it's going to be a very rude awakening to people who haven't figured it out yet.
To understand why Rick Rule is so bullish on silver, we need to look at the bigger picture, the global macro environment. With inflation soaring and interest rates staying low, more and more investors are shifting their focus to tangible assets like silver. Unlike cash, Silver holds intrinsic value that can't be eroded by inflation. In times of economic instability, it's often seen as a safe haven, an asset that retains value when other investments falter. And right now, with so much uncertainty in the financial markets, silver's appeal as a hedge is stronger than ever.
Need to understand that we have at least two hot wars going on. First of all, Russia and the Ukraine, and Israel versus the rest of the Middle East. And despite the fact that those things haven't impacted us directly in Western Europe and North America, there's certainly things that impact the world economy, and there are certainly things that we need to consider as risks. The second thing, of course, is an upcoming U.S. election. From my viewpoint, between two bad candidates, but that's a different issue. And the third, I guess, is an economy that, at least in the U.S., while still strong in a headline sense, is not working for all people, and one where you have an ongoing challenge with artificially low interest rates and stubbornly higher inflation. So I think we have an interesting set of circumstances to navigate. I'm not, as you know, a doom and gloom guy. I believe that the world will be a substantially better place ex-war 20 years from now than it is today. But I think we have some challenges to get through in the next 2 or 3 years, and I think investors need to keep those challenges in mind.
One of the biggest reasons silver is gaining traction is its role as a safety net beyond traditional investments. With doubts looming over the sustainability of government entitlements like Social Security, people are looking for assets they can control, assets that hold value no matter what. Silver, often seen as a personal savings account, is appealing to those concerned about future benefits and financial security. Unlike fiat currency, silver's intrinsic value isn't tied to any government promise, making it a reliable store of wealth that people can count on even if social safety nets falter.
The allocation of state funding is opaque. The allocation of the banks, including the private banks, many of which are sub rosa state funded, extremely opaque. And the non-bank financial sector is opaque. A lot of the lending apparently is politically or crony inspired. Some of that money has been invested well. Not all of it has. And there's probably going to be a reckoning in the Chinese system. I'm highly confident that the Chinese will get through it. There's a lot of liquidity in China, and there's a lot of surplus generated until Americans, among others, cease to want to buy reasonable quality, inexpensive Chinese goods. There will be substantial economic surplus generated by China. And if they manage not to waste all of it, and if they cure some of their bad habits, I think the future in China is extremely bright.
Another major factor driving silver's potential is its essential role in modern technology and green industries. Silver isn't just a precious metal. It's a critical component in products we use daily, everything from electronics to solar panels and medical devices. As AI, renewable energy, and tech sectors continue to surge, the demand for silver is set to climb sharply. It's these irreplaceable qualities in high-tech and green energy applications that make silver an industrial powerhouse, positioning it for significant price growth as these sectors expand.
When you go to China, you can't help but be impressed by tens of millions of hardworking people who save 50% of post-tax income, educate themselves continuously, educate their children. You can't help but be impressed by the level of capital investment that takes place in China and the amount of infrastructure investment that takes place in China, particularly compared with Western Europe and North America. The challenging part of China is that it's an autocracy. There's 10 billion people who run a country of 1.4 billion people. 10,000 people can't have access to enough information to do that. So the possibility of mistakes, given that concentration of power, is huge. And the opacity in the Chinese system scares one. So while I'm a very, very, very optimistic long-term bull, by long-term I mean 10 and 20 years around China, I'm near term afraid that the growth rate will slow and they will face increasing challenges, particularly social and political challenges, but also credit challenges, because I think the allocation of capital in China has involved too much politics and not enough utility. And I think that will give them problems in the next 5 years. There have been, I think, regional overinvestments in real estate. And I think they need to work their way through that. And I think that the opaque nature of credit in China needs to resolve itself before the rest of the world can rely on China to be the growth engine that it was sort of beginning in 1990.
Supply constraints in the silver market add another layer to this bullish outlook. Unlike gold, most silver is produced as a byproduct of other metals like copper and lead. And with underinvestment in base metal mining, silver production could face serious limitations. This reduced investment in mining operations means silver supply might tighten just as demand is set to rise, potentially creating a supply-demand squeeze. In short, if silver production can't keep up with growing demand, we could see prices pushed even higher.
We have lived through a very benign period. A period of declining real interest rates, a period of a declining cost of capital. And this has been good for entrepreneurs. It's been good for financiers too, in the sense that they had access to capital. But I think the real cost of capital is going to increase. I think inflation is going to increase. I think that ultimately, at least nominal interest rates are going to increase. And I think that returns on capital are going to be spottier. The people who understand how to deploy capital are going to do extraordinarily well, if for no other reason that there will be less competition in the space. The rising tide won't float all ships. If you look back to the long period of stock market stagnation that we had in the United States, for those people who aren't old enough to remember it, the period 1968 to 1982, there were certain people, Tisch, Buffett, people like that, who understood how to deploy capital, and they enjoyed 20 and 25% compound internal rates of return when people in the broad market were enjoying 1 or 2%. So I think that the rewards to capital will, again, increasingly be disproportionate and allocated to expertise rather than a circumstance where everybody benefits because the wind is in everyone's sails.
With economic uncertainty on the rise, many investors are rethinking the composition of their portfolios. Silver stands out as a unique investment because it serves a dual purpose. It's both a precious metal and a highly sought-after industrial commodity. This dual nature makes it especially valuable in today's volatile market. As more investors recognize silver's potential to not only hedge against inflation, but also participate in the booming tech and green industries, demand is likely to grow. Silver isn't just a safe haven, it's also a strategic piece in a diversified portfolio, giving it an edge as a flexible, resilient asset that can thrive in various economic conditions.
I think we began a period post-World War II, but more importantly, post the 1970s, where we had a respite from reality. We had, as you suggest, a whole bunch of tailwinds. Globalization, the increased participation of women in the marketplace, the demographic benefit of the baby boomers entering their working and productive years, the outbreak of peace, the so-called peace dividend as the Cold War succeeded. We are unfortunately experiencing the unwinding of some of those benefits. We are increasingly nationalistic, which makes everyone poorer. The baby boomers, that demographic boom, at least in the West, is busted, which will be a challenge. The productive class has become an unproductive class, has become a drag on society, which we need to come to understand. And I think that we're going to have, sadly, a reversion to mean in terms of the accretion of value to those who are disproportionately capable of adding value. Those people will benefit, and those people who are not capable of keeping pace will find that their market share, if you will, the amount of value that they enjoy relative to the amount of value that people who are more competitive enjoy, will return to historical means, which is to say extremely disproportionate.
Let's talk about the silver mining industry and how rising prices could impact it. When silver demand increases, the value of silver mining companies often follows suit, making these companies attractive investments in their own right. As the industry braces for heightened demand, we might see an uptick in mergers and acquisitions, with larger mining firms seeking to acquire smaller companies to bolster their reserves. This consolidation could lead to more efficient production and potentially higher valuations for silver mining stocks. For investors, this means that a rising silver price doesn't just increase the value of physical silver, it could also spark a profitable wave in the mining
But
sector,
I think that Social
amplifying
Security,
silver's
as an
appeal across
example,
the
will
board.
become means tested. People who paid into it for 50 years like me won't like the fact that they're going to be excluded from it, having paid into it. But that's what's going to happen. The age will change too. Social Security begins at age 62. When it was instituted, the average life expectancy of an American male was 66 years of age. It's not any longer. So the starting period for Social Security is probably going to be some number like 70. But the most important thing to recognize is that the way that we're going to default, because we are going to default, is going to be a default on the installment plan, which is to say that we will inflate away the net present value of the entitlement. We will do what we did in the 70s. In the decade of the 70s, the obligations didn't go away, but the purchasing power of the US dollar fell by 75% over the course of the decade. If you went into the decade of the 70s with a $400 or $500 a month income, you were in relatively good shape. If you came out of the decade with a $400 or $500 a month income, what happened is that on a purchasing power basis, you lost 75% of your purchasing power, which was a very bad thing. We're shaping up to do the same thing in the next 10 years, a substantial deterioration in the purchasing power of US dollar savings and investments. And people need to understand that. The real way that we deal with the net present value of entitlements is reducing them by inflating away their net present value.
As we look further into silver's role in investment portfolios, its unique appeal as an inflation hedge and diversifier becomes clearer. Unlike traditional assets that often fluctuate with market conditions, silver tends to hold steady or even gain value during economic downturns. This has led savvy investors to add silver to their portfolios as a form of insurance against volatility. But silver's industrial uses set it apart from other safe haven assets like gold. By holding silver, investors are not only hedging against economic instability, but are also tapping into a growing demand across tech and renewable sectors. It's a powerful asset for anyone looking to balance stability with growth potential.
To believe that the government is there somehow to help them. I look particularly at the United States, where I'm resident, and when I talk to other Americans, they believe that the whole panoply of social safety nets, the whole panoply of entitlements that Americans of my generation have enjoyed will continue to be available. And I think that's wrong. Sadly, the on-balance sheet liability, which is to say the debt to bondholders in the United States, now exceeds $35 trillion, over 110% of GDP. But much more challenging, the off-balance sheet liabilities of the U.S. government, which is to say mostly entitlements, Social Security, Medicare, Medicaid, federal pensions, military pensions, that sort of thing. The net present value, not the nominal value of that debt, exceeds $100 trillion. which is to say it's arithmetically unsustainable. The on-balance sheet liabilities, which are $35 trillion, grow in excess of $2 trillion a year. In other words, they aren't getting paid down, they're getting made worse. The Congressional Budget Office suggests that the accretion of the unfunded deficit in the net present value of entitlements is increasing by something like $4 trillion a year. This social obligation that we have to each other, or rather, that the spenders have to the savers, is completely unsustainable, and it won't be sustained. People who believe that the government has either the responsibility or the ability to discharge the obligations that they have to themselves or their families are in for a very rude awakening. It's not going to happen. People at your age, Anthony, need to understand that the whole collection of entitlements that my generation have enjoyed have been in some sense fraud. They've been an income transfer, in effect, to us, the people who voted ourselves all kinds of cool benefits, but forgot to pay for them. We got the benefit, and we're leaving you the responsibility. You have the right to feel aggrieved, but in addition to feeling aggrieved, you need to understand that the level of benefits that we enjoyed are not going to be available to you, and you need to plan accordingly.
Silver's reputation as a hedge against inflation is another critical factor in Rick Rule's bullish outlook. Historically, precious metals have been a go-to investment during inflationary periods, as they tend to retain their purchasing power while currency values decline. Silver, in particular, is accessible to a broader range of investors due to its lower price point compared to gold, making it an attractive choice for those looking to safeguard their wealth. With inflationary pressures showing no signs of slowing down, silver's role as a defensive asset becomes even more compelling. As inflation eats away at traditional savings, silver stands firm, offering a tangible store of value that's hard to ignore.
Expanding Exxon's footprint in the Permian Basin at the same time that they're developing offshore Guyana, the takeover of Hess by Chevron, as you suggest, the mooted takeover by BHP of Anglo. You're seeing consolidation throughout the natural resource business. You're seeing it because margins are increasing. In other words, guys can afford to do these takeovers. You're seeing it too because there are economies of scale. Larger companies have more liquid stocks and hence higher share prices. And there's a dichotomy in cost of capital between the very large companies and the rest. The guy with a lower cost of capital wins. That's what happens. And you're seeing it too because of the long lead times that are necessary. In order for Exxon to replace production, it's difficult to do it with the drill bit. They have to do it with acquisition. And acquisitions are uniquely attractively priced now relative to both the cost of capital and the future trend, I think, in commodity prices.
One of the most exciting aspects of silver's future is its indispensable role in green technology and electronics. As the world accelerates its shift toward renewable energy, the demand for silver is skyrocketing, particularly in solar panel manufacturing, where silver's conductivity is unmatched. Electronics, too, depend heavily on silver for its reliability and efficiency in circuits and batteries. With governments worldwide pushing for greener energy solutions, silver is poised to become even more valuable. As these green technologies evolve and expand, silver demand will only intensify, creating upward pressure on prices that could drive a sustained rally.
What I suggested is that, first of all, the disparity between the gold and the gold price was easy to understand. The central banks were buying gold, and central banks don't buy gold shares. So it makes sense that the follow-over wouldn't happen in the gold shares. But we also talked about the fact that for the gold shares to begin to participate as stocks, they had to participate as companies. And the margins that gold producers enjoyed didn't match the increase that one would have expected with the increase in the gold price. That's easy to understand because at the same time that the price of gold went up, the price of inputs, the price of cost to produce the gold went up too. Social rents in particular have increased at 20% compounded. Labor has increased, energy has increased. What you are coming into now, however, is a period where the companies have done a reasonably good job at cost containment, And they are beginning now to enjoy the increase in the gold price and increased margins. In the next 4 weeks, we're going to have a lot of quarterly reports. And I think we're going to have a lot of upside surprises in the near term, particularly with companies that have traditionally been good on the cost side. The Agnico Eagles of the world and the royalty and streaming companies, the Wheaton Precious, the Franco-Nevada. But I think that you're going to see it come down into the secondary tier too. You've already seen an absolute blowout quarter from Lundin Gold. And I think that you're going to see, with increasing frequency, gold mining companies on all ends of the size scale surprise to the upside with the quarterlies. The second thing that I think you're going to see, and we talked about this before too, is because of the long lead times, because we've underinvested in exploration, and because of the permitting delays, you are going to see a lot more merger and acquisition. The only way companies are going to be able to grow in the near term isn't with the drill bit, and it isn't with the bulldozer. They're going to have to grow on Wall Street and Bay Street. We've already seen mergers and acquisition through the space, and I think the pace of that, as margins increase, and as the cost of equity capital perhaps begins to fall, I think you're going to see a lot more M&A activity.
Silver's potential for growth is not only driven by increasing demand, but also by a concerning factor: its scarcity. Unlike some other metals, silver isn't typically mined in isolation. It's most often extracted as a byproduct of mining for other metals like copper, lead, and zinc. This means that fluctuations in the mining output of these metals can directly impact silver's availability. Furthermore, high-grade silver deposits are becoming harder to find, leading to increased extraction costs and, ultimately, tighter supply. While recycling can offset some of the demand, the supply of recycled silver simply can't keep pace with the rising need in industrial applications. In fact, analysts warn that if mining investment doesn't pick up soon, silver could face a significant supply crunch in the coming years. This looming shortage, combined with surging demand from both the investment and industrial sectors, could create a perfect storm that pushes silver prices to unprecedented highs.
Exploration part of US E&P is mostly gone with the incredible amount of data that we have, and with three-dimensional seismic. You know roughly where the oil and gas is. As a consequence of horizontal drilling and a lot of drilling technologies, the penetration rate is up by 350%. Drilling is 350% more efficient than it was 20 years ago, which is astonishing. The fracturing technologies, our ability to custom tailor the fracturing protocol and the fluids to specific locations, means that fracking itself is way, way, way more efficient than it was 20 years ago. The conjunction of those technologies is really what has led us to the boom that you describe. And to the extent that technological innovation doesn't keep pace, which is to say, to the extent that the rate of increase in efficiency doesn't keep pace with the rate of efficiency increases that we've enjoyed over the last 20 years, geology is going to become less and less forgiving.
Investment demand for silver is another powerful force that's gaining momentum. Over the past few years, we've seen an explosion of interest in silver-backed investment vehicles, like ETF, which made it easier than ever for both retail and institutional investors to gain exposure to silver without the hassle of physical storage. Silver coins and bullion remain popular among traditional investors, but ETF have opened the door for a much wider audience, creating a broader and more consistent demand. What's more, with increasing interest in sustainable and ethical investments, silver's reputation as a key component in green technologies enhances its appeal. Investors looking to align their portfolios with socially responsible initiatives are finding silver to be an ideal choice. This combination of easy access through ETF and alignment with ethical investment trends has made silver a highly sought-after asset. As this trend continues, investment demand could become a significant driving factor for silver prices, providing a steady tailwind that supports Rick Rule's predictions.
Is that although we have managed to double U.S. supply in a fairly short period of time, just over a decade, we have done that because we were able to employ several new technologies: horizontal drilling, management well drilling, three-dimensional seismic, and fracking technology. The low-hanging fruit associated with that, which is to say the Class A undrilled locations in places like the Delaware, the Permian, the Eagle Ford, are in some danger of being drilled, which is to say, without further advances in technology, we're going to be left drilling our B-grade locations, which means that the surge is over. If you combine that, and I'm not saying it's going to occur, I'm not saying that technology won't continue to increase. Maybe it will. But if we don't, and if the interest rate rises in a capital intensive business, you could have some supply problems. One of the things that you learn in these shale projects is that the decline curves are extremely rapid. In the old conventional projects, your decline curve may have been 10, 12, 15%. In the shale projects, it's not uncommon to have 75% of the production of the well occur in 18 to 24 months. Now, sometimes you can retreat those wells and go back and increase production. But what people don't seem to understand is that without the constant application of capital to tier one locations, the production growth that we have seen can go into very rapid decline. And in the circumstance that you describe, which is to say falling commodity prices with less incentive to drill and less incentive for people to provide that capital, the fall off in production because of decline rates in these shale projects is as dramatic as the ramp up was.
Adding to silver's allure is the current wave of global macroeconomic instability, which has investors everywhere on edge. Geopolitical tensions, trade disputes, and the lingering effects of the COVID-19 pandemic have all contributed to a climate of uncertainty, pushing investors towards safe haven assets. Historically, when uncertainty strikes, precious metals like gold and silver become incredibly appealing due to their intrinsic value and resilience. Unlike stocks or bonds, which are vulnerable to sudden swings in market sentiment, silver offers a level of stability that's increasingly rare in today's markets. And with silver's dual role as both an industrial metal and a safe haven, it has a unique ability to appeal to a wide array of investors. In a world where financial systems are feeling increasingly fragile, silver's stability and reliability stand out, fueling its attractiveness and driving up demand. As these global pressures show no sign of abating, silver's status as a trusted asset could play a pivotal role in pushing prices higher, as Rick Rule foresees.
That inflation increases means that all of those costs increase. And if inflation increases, it's not unlikely, as far as I'm concerned, that the market begins to recontrol interest rates rather than the government controlling interest rates. And if you have the circumstance where inflation is rising and the interest rates are higher, the real cost of developing productive capacity and resources goes up too. And people need to understand that. The 40-year period of declining interest rates has forestalled some of the problems in natural resources because the cost of capital has been unrealistically low. Part of the boom that we have seen in U.S. oil production has to do, first of all, with the conjunction of technologies that were appropriate, but also has to do with the very low cost of capital the oil industry has enjoyed in the United States. And if you begin to reverse that, if the march of technology, as an example, in the oil and gas business slows, or if the cost of capital goes up, or if the social rents, taxes, and royalties go up too much, you will exacerbate the supply problem and goose the prices.
One fascinating element adding weight to Rick Rule's prediction is the historic price ratio between gold and silver. For decades, the gold-to-silver price ratio has served as a benchmark for investors, typically hovering around 60-70 to 1. However, this ratio has remained stretched in recent years, with 1 ounce of gold now buying nearly 90 ounces of silver. Historically, such a wide ratio often signals that silver is undervalued compared to gold, suggesting a potential reversion to the mean. This reversion would require a substantial increase in silver's price to bring the ratio back in line with historical norms. If silver were to close this gap, it wouldn't just be a minor rally, it would represent a dramatic shift, with significant gains for silver investors. This potential rebalancing of the ratio reinforces the bullish outlook and adds another powerful reason why silver could be poised for a substantial surge, aligning with Rule's high expectations.
In industrial materials, oil and gas and base metals for 30 years. That's okay because we overinvested in them in the 70s and the 80s. So we're living off the surplus that was generated from a period of overinvestment. But that period's over. We are living as a species off oil fields and copper mines that are as old as me, which is to say they're well past their prime. And we are going to have supply shortfalls. We are still underinvesting in productive capacity in base metals, and particularly oil and gas today. And if you underinvest, if you reduce sustaining capital investments in capital-intensive businesses, you get away with it for a couple of years, 2 or 3 years. But over time, you impair your ability to produce. Look at the copper business as an example. We discovered way too much copper in the 70s and 80s. So looking for copper in the 90s, the 2000s, wasn't a great business. But because we didn't invest, we have a shortage of copper development projects. 30 years ago, the median grade of a copper mine worldwide was 1.5% copper. Today, the median grade is less than a third of that, less than 0.5%. And even at that, there's a shortage of development projects. Meanwhile, the cost to put a project in production, all costs are increasing fairly rapidly. One example would be the Resolution mine in the state of Arizona, allegedly a politically secure jurisdiction. That mine, over 1 billion tons of 1.5% copper in a place with wonderful infrastructure, in a community that's full of copper miners, has now been 26 years in permitting. 26 years in permitting. That discourages exploration for copper worldwide. It discourages development for copper worldwide. Meanwhile, we're using copper at a breakneck rate. It isn't merely increasing demand, which will happen with poor people in emerging markets becoming more wealthy. It's the fact that we have underinvested for so long that almost no matter what we do, other than a global depression, we're going to have supply shortages.
Bringing it all together, Rick Rule's prediction for a new all-time high in silver is backed by a unique convergence of powerful forces. From inflationary pressures and economic instability to surging industrial demand in tech and green energy sectors, silver's appeal as both a safe haven and a critical industrial metal has never been stronger. With limited mining investment constraining supply and a growing awareness of silver's undervaluation compared to gold, the stage is set for a potential price surge that could redefine silver's position in the market. If these factors continue to build momentum, Rick Rule's forecast might not just be a bold claim. It could be a glimpse into the future of silver as a powerhouse asset. For investors, this is a rare alignment of market dynamics, and those who act now could find themselves at the forefront of a historic rally. Remember, though, this is not financial advice. Invest wisely and always consider the risks. And if you found value in this analysis, be sure to subscribe to stay ahead of the curve in the world of precious metals.
Is during times when metals prices are low, you'll look, if you're careful, at the difference between the reserve grade, which is to say the average grade of the company's total reserve and resource package, and the mine grade, which is to say they mine the higher grade materials during periods of low commodity prices. They produce for cash. And often they account for this on a unit of production basis rather than on a reserve basis, which is to say they don't report the true depletion and the true depreciation that they're experiencing at the mine face. And what that means is that irrespective of what they do in terms of cutting costs on operations, their cost on a unit of production basis goes up because they've high graded the deposit. This is fairly subtle, but it's something that's happened again and again and again in my career. When I look at periods of low commodity prices, and all the companies do it, what you see is that they mine high-grade material to generate cash. When that high-grade material has been taken out of the ore body, the average material has a higher cost relative to the minerals extracted from it. So that even if commodity prices go up, the cost per unit of production goes up because they've already taken a lot of the good milk out of the deposit.